In April 2023, in a bank branch in Phoenix, Arizona, Danielle sat across from a loan officer and watched him frown at a screen she could not see. She had never missed a payment in her life. She had no debt. The number on his screen said 680, and because of it, the loan would cost her $11,000 more.
This is the story of a number that is not what you think it is. Danielle is 29. She does everything right. She pays cash. She avoids debt the way her parents taught her to. She had assumed, reasonably, that a person who owes nothing and pays for everything would have an excellent credit score. She was wrong, and the reason she was wrong is the entire point. Here is the belief that keeps people trapped. People think a credit score measures how responsible you are with money. It does not. It measures how profitable you are to lenders. Those are not the same thing. They are often opposites. And until you understand that the score was built by the lending industry to serve the lending industry, you will keep playing a game you think you are winning while you are quietly losing. Start with how the number is built. Roughly 35% of your score is payment history. Another 30% is how much of your available credit you are using. 15% is the length of your credit history. 10% is your mix of credit types. 10% is new credit inquiries. Read that list again and notice something. Almost every single factor requires you to be borrowing money. You cannot have payment history without debts to pay. You cannot have a credit utilization ratio without credit being utilized. You cannot have a length of credit history without years of being in the system. Danielle paid cash, so she had no payment history, no utilization, no mix. The system did not see a responsible person. It saw a stranger, and the system does not reward strangers. It rewards participants. This is the trap stated plainly. To have a good credit score, you must be in debt or at minimum perpetually borrowing and repaying. The score does not measure your freedom from debt. It measures your reliability inside of debt. A person who has carried a balance, paid interest, taken loans, and stayed entangled for 15 years will score higher than a person who owns everything outright. The system is not broken. It is doing exactly what it was designed to do. Consider who built it. The modern credit score, the FICO score, was created by a company that sells the score to lenders. The lenders are the customers. You are not the customer. You are the product being rated. When a system rates you for the benefit of someone else, it optimizes for their interest, and the lender's interest is not that you become debt-free. The lender's interest is that you remain a borrower for as long as possible, paying as much interest as the system can extract while keeping you just stable enough to never default. That is what a good credit score actually certifies. Not that you are wise, that you are a dependable source of interest payments. Now watch the mechanism that keeps you inside it. Credit utilization. The score punishes you for using too much of your available credit. So the advice is always, keep your balances low relative to your limits. Sounds responsible, but follow the logic. To keep utilization low, you are encouraged to hold open credit lines you do not use and to request limit increases you do not need. You are being trained to expand your access to debt in order to look good to a system that profits from debt. You are not escaping the casino. You are being handed more chips and praised for not spending them yet. And the moment you do the genuinely responsible thing, the system punishes you. Danielle, years earlier, had closed an old credit card she no longer wanted. Her score dropped. Closing the account shortened her credit history and reduced her available credit, which raised her utilization ratio. She had removed a temptation from her life and the system penalized her for it. A 2021 report from the Consumer Financial Protection Bureau noted that closing accounts is one of the most common unintentional causes of score drops. Doing the right thing costs you points. Here is where the cost becomes real money. That 680 score on the loan officer's screen was not a moral judgment. It was a price tag. On a 30-year mortgage, the difference between a 680 score and a 760 score can be most of a percentage point in interest. On a $300,000 loan, that gap is tens of thousands of dollars over the life of the mortgage. Danielle's caution with money, her refusal to borrow, was about to cost her more than a person who had spent 15 years comfortably in debt. The score does not just describe your financial life. It sets the price of it. Lower scores pay higher interest on everything: mortgages, car loans, credit cards. They pay higher insurance premiums in most states because insurers use credit-based scores. They pay deposits on utilities and phones that higher scores skip. A 2020 analysis found that drivers with poor credit can pay substantially more for car insurance than drivers with excellent credit and identical driving records. The penalty for a low score is applied to people who, very often, simply have less money. The system charges the most to those who can least afford it. This is the quiet engine underneath it all. The people with the worst scores pay the highest prices, which keeps them poorest, which keeps their scores low. The people with the best scores get the cheapest credit, which lets them build wealth, which protects their scores. The number does not just measure inequality. It manufactures it, and then dresses the result up as a fair and neutral metric. So what is a person actually supposed to do, knowing the game is rigged toward keeping you inside it? You do not get to opt out. The score governs your mortgage, your apartment application, sometimes your job. Refusing to play the way Danielle did just leaves you invisible and penalized. The honest answer is uncomfortable. You have to play the game while never believing it is measuring what it claims to measure. That means using credit deliberately and minimally. A single card, paid in full every month, generates payment history and utilization data without paying a cent of interest. You are feeding the machine the data it wants while starving it of the profit it expects. You keep old accounts open even when you do not use them because the system rewards age. You let the score climb. And critically, you never confuse the number going up with actually being wealthy. The score is a key to cheaper debt. It is not money. It is not security. It is a credential issued by an industry that profits when you stay in the room. Danielle understood it eventually. She opened one card, ran a small recurring charge through it, paid it off automatically every month, and never touched the rest of her habits. 18 months later, her score crossed 760. Nothing about her actual financial responsibility had changed. She had simply learned to perform reliability for a system that was never measuring it in the first place. And here is the part that should sit with you. You have probably been told your credit score is a report card on your character. That a high number means you are doing well and a low number means you failed. You may have felt pride at a good score or shame at a bad one. Both reactions are exactly what the system wants, because they keep you emotionally invested in a game whose rules were written by the people collecting your interest. The score is not your worth. It is your usefulness to a lender translated into a number sold back to you as if it were about you. Right now, somewhere, your number is being checked and a price is being set and a profit is being calculated, and none of it is on your behalf. The only question is whether you'll keep believing the number is grading you or finally see who it was built to serve.